Hello everyone, friends. Today we're going to talk about a topic that sounds complicated but is actually understandable to everyone. If you're just starting your journey in online trading and thinking liquidity, what even is that? You should watch this video to the end so you can have a clear understanding in just a few minutes. Liquidity is the fundamental concept you consciously move forward without understanding. This isn't theory for the sake of theory. It's a real foundation that directly affects how you'll make decisions and why unexpected things sometimes happen in the market. And there's a little secret. If you master this topic, you'll be a step ahead of most beginners who skip it because it seems boring. So let's start with the most important part. The definition. Liquidity is a measure of how quickly one asset can be changed for another. Let's imagine a situation. You have the latest model smartphone. If you want to sell it, you'll probably find a buyer right away. That's high liquidity. The ability to easily turn something into cash. Now, imagine an old flip phone. Finding a buyer will be problematic. And even if you do, the price will be lower than you expected. That's low liquidity. The same principle works in the market. There are assets that are easy to exchange, and there are those that get stuck. To unlock an understanding of the market, you'll need to realize two things. Firstly, high liquidity means there are always enough participants willing to buy or sell an asset. These create a sense of confidence and stability. Secondly, how liquidity can play a nasty trick. The price may start changing too unexpectedly because there are a few participants in the market. Any action can move the price in a different direction. By the way, friends, I've created a separate Telegram channel where we break down such topics in detail using simple language. There, you can ask questions, discuss your observations, and look at practical examples. I'll try to explain everything so that even a beginner can understand, from basic things to liquidity to more complex points. If you're interested, the link is in the description down below. Join us, and liquidity is exactly one of those topics we often discuss because it determines how easy it is to enter or exit a trade and how the price will behave. For example, imagine you decided to sell an old house in a remote village. There aren't many buyers for properties far from urban infrastructure. Such an asset could take years to sell, even at a big discount. Now consider an apartment in the city centre with a convenient location, near infrastructure, transport hubs. You could sell such an apartment above cost within a few weeks or months. For a trader, the concept of the level of liquidity means that with high liquidity, it's easier to enter and exit trades, while with low liquidity, there's a higher chance of getting stuck. Liquidity doesn't just appear out of thin air. It is influenced by several factors. For example, the number of market participants. A large number of active participants increases liquidity as it raises the number of potential counterparties for transactions. Trading volume. The higher the trading volume in the market, the higher its liquidity. Large volumes mean there are enough buyers and sellers willing to make trades. Liquidity can also change depending on the time of day and the market events. It's worth considering the fact that liquidity can change. An asset is liquid today, but can become quiet tomorrow. To make this point clear, let's look at an example. Imagine you want to buy a popular stock of a cool company. An incredible number of trades happen in it every day. So there are many buyers and sellers. The price changes smoothly and you can buy or sell at any moment. That's high liquidity. Now, let me give you an example of low liquidity. For instance, a small unpopular company with a few trades. To buy its shares, you might have to wait, and if you want to sell, there might be no buyers. In such cases, the price will jump sharply and unexpectedly. It's important to understand that liquidity isn't theory for the sake of theory. It's a tool that helps you make decisions. When you look at an asset, ask yourself, how easily will I be able to exit the trade if I want to? If it's very easy, then liquidity is high. If it's difficult and unclear, then liquidity is most likely low. So let's summarize. What did we find out today? Liquidity is the ability to quickly exchange an asset without significant losses. High liquidity provides stable, while low liquidity can lead to sharp price improvements. And if you want to move forward in trading consciously and avoid mistakes, then start paying attention not only to charts and strategies, but also to liquidity. Well guys, I hope this video was useful for you. Thank you for watching until the end. If you want more educational content, want to delve deeper into trading topics, and get additional materials, examples of journal entries and breakdowns, be sure to join our Telegram channel. There I share useful notes, answer questions, subscribe so you don't have to navigate trading alone, because moving forward together is easier.